Hi, I'm Hansi. I'm the founder of a portal called The Money Hans. After 20 years of research and consulting, I now love to educate people like you on investor education. And you know, one of the most frequently asked questions that I get is how to pick that mutual fund. And it's not as simple as it sounds. To help us discuss that, we have today Kaustubh Belapurkar, who's the director of Morningstar. Morningstar is one of the world's biggest rating firms. So let's get right into it.
Hi, Hansi. Thanks.
Let's start with, as I said, the most frequently asked question that I get is, all that gyan is fine, but which fund to pick? And I see so many people talking about, let's just pick based on the last 1 year, 3 year, even 5 years. But it's not that easy, is it? How hard is it to pick a mutual fund?
Hansi, trust me, it's a really, really hard job. So, you tend to look at returns, investors tend to look at returns. We call that revenue mirror driving. But what's important to acknowledge is that, okay, a fund manager has delivered returns, but is that going to be sustainable going forward? I think that's something you need to acknowledge and understand. And we spend a lot of time in Morningstar trying to understand strategies, the processes, the strengths of people before we actually put out a conviction that a manager can potentially outperform. And trust me, it's a really, really hard job to consistently pick funds that are going to do well over the long term.
So that's when you have thousands of people all over the world and you sell that research to fund advisors, right? Mutual fund distributors and advisors. So that means a retail investor really has to find a good advisor to be able to get access to that research. That's right?
Yes, absolutely. And I think, it's very important to acknowledge that because sometimes, and behavioral sciences has shown us that if you're presented with too many options, more often than not, you don't end up making a choice, which is actually counterproductive to the reason why you were looking at those choices, right? And that's where I think, some simplified options could really work for an investor.
I absolutely agree with you. I think retail investors being asked to go and make that choice out of these thousands of mutual funds or having to go and see a financial advisor when they can't afford it is not really fair. I think whether it's your health or your wealth, when you're young and healthy, maybe until the age of 40 or so, you should be able to look after your own money and your own health. So my advice to people is just get started with a very, very basic fund structure called an ETF, an exchange traded fund. Do you agree?
Yeah, I would definitely like to think so, right? So an ETF, if you look at it, is a very, very simple mimic of an index. Now, we as investors tend to track, we look at the markets, we think of the Nifty, the Sensex, right, the broader indices. But do we really get exposure to these indices is the question, right? An ETF can do exactly that for you. You just need to park that money into the structure, which is an ETF. You can buy that directly on the exchange through your broker, and you get access to an equity index. You don't need to worry about that. The fund manager that I've picked, is he going to outperform the market or not? Is he going to be holding cash? All of those elements really go out of the window. So it's a very good starting point where someone doesn't want to spend too much time trying to figure out which fund's good or not for me. It's like an autopilot of sorts.
So an ETF is basically a passive mutual fund, right? So that's the first point. But the difference is that it itself is listed on a stock exchange. What is the benefit of that? Why would someone want to buy a passive fund on an exchange?
So obviously the benefit, one is that, you can kind of buy it at any time. So, one of the sort of, I wouldn't say drawbacks, but one of the elements of a mutual fund is that you get the end of day NAV. Now, if someone who wants to kind of track a price more closely, he can very quickly buy it off the exchange, through his broker immediately at the price that's available.
Would you recommend that?
I wouldn't say in all cases, but it's more about the concept of passive investing, like we spoke about. That's the bigger draw of an ETF right now.
I would say I would agree with that. I would say buy an ETF or a passive fund, and then put it in your bottom drawer and forget about it. Right? That's the long-term sort of way of investing. In fact, Warren Buffett, who's considered the richest investor in the world, says that even for his own wife or for his own kids, he recommends that, in fact, for 90% of most investors, he actually says that they're better off investing in a passive fund or an ETF and forgetting about it long term.
Right.
Do you agree?
Yeah, so I would say a mix of yes and no there. And, it's an interesting take. So if you look at the US market, which has really evolved, people have clearly moved towards passives. Most of the flows are increasingly going towards passive funds, active funds, because it is so hard for an active fund manager to beat the index. From an Indian context, I think it's still an evolving scenario. One is that the ETF market is still nascent, but it's growing, which is good. Active managers still do have an element of alpha that some of them do provide, but like we said, that's as the market's growing, that's going to keep getting harder and harder to provide. Then the other thing that we spoke about is liquidity, and that becomes very, very important from an ETF context, right? Right now, we think liquidity hasn't gone to where it should be, so it becomes a little bit harder to pick or buy an ETF off the exchange. But it's like a chicken and egg situation. Finally, you need to get in investors, a lot of them buying ETFs, that becomes a vibrant liquid market. And I think we're going to get there, as investors kind of progress through the investing cycle.
As a retail investor, do I really care about liquidity? I mean, if I'm buying an ETF and I'm holding it, what do I care if there isn't? I mean, I'm not selling it anyway, long term anyway. Right. So does it matter?
It does matter to a certain extent in terms of, if you're getting a fair price for what you want to buy it, because if you're trying to track an index, you want to, minimize the cost, or what they call the bid-ask spread, in terms of when you're purchasing a unit. Now, liquidity could potentially drive that. So that's where I would keep a mind or kind of view on that, and that's where when you're even looking at the ETF universe, you'd want to look at costs, obviously, which we have some super cheap ETFs now on the more broader indices. That's something you definitely want to look at, and liquidity is another factor overlay I would definitely want to look at.
So if I'm a retail investor and I just want to get started, I don't want to get bogged down by which mutual fund and how to find an advisor and all of that. I just want a nice, cheap, passive ETF. Which ETF would you recommend? Is it the broad market index, or is it on the something like the Nifty, the large cap?
Yeah, so I would definitely go for a Nifty or a Sensex, a good starting point.
Just the 30 or 50 stocks?
Your simple large cap, sort of, your bellwether stocks, really well-known names. Those would really be the ones to start with. And once you've kind of dabbled in the idea of equity investing, then you can go around to the slightly more esoteric sort of ideas, be it on a value index or a dividend index. But to start with, you should just
complicate things. That defeats the purpose of this. Then we might as well go and pick active mutual funds, right? So I think, smart beta, what you're talking about is something more complicated, right? We would have to explain it. And I think with ETFs, the problem is obviously there's no trail commission being paid, and there's no sort of trade body doing a mutual fund sahi hai type campaign, right? So my vote is just buy a simple broad market index, ideally the S&P 500, the BSE S&P 500, or the Nifty, and long term forget about it.
Yeah, absolutely. I mean, that's definitely a thought. And like you said, right? It's if I had borrowed the Hero Honda campaign, the fill it, shut it, forget it. That's really the role of an ETF in your portfolio, and you should definitely hold on to an ETF.
That's great. Thank you so much for that discussion. That would help a lot. There you have it. Picking mutual funds is hard, but that shouldn't stop you from getting started. The easiest way to do that is to pick an ETF, exchange traded fund, on a broad market index like the NSE 500 or the NSE Nifty, which is the top 50 stocks. Just buy that, put it in the bottom drawer, and let it run for the very long term. Happy investing.